Welcome to our second quarter overview for the industrial segment. Here we're talking about a unique piece of the overall industrial market that's kind of like popular or people know about most. We really only look at shallow bay, flex, kind of older 15 plus year old properties. So this is a very small segment of the overall industrial market. In Atlanta specifically, there's something like 100 million plus square feet of industrial space. And this shallow bay product is really less than 5 million square feet total.
Yeah, not only is it's only, we can call it barely 5, maybe 6% of the entire submarket of industrial, but also we are focused on small square footage tenants. So flex, if you're going to build a new flex product right now, you're building probably 20 to 30,000 square foot bays. Yeah. When we're really focused on a 3 to 7,000 square foot tenant. So we're buying 15 to 25-year-old buildings that have these larger bays and then dividing them up and adding more doors to them. Or we're flexifying a building.
Yes.
So we're taking a single-story office building and making more office flex or office industrial.
Well, we're taking office buildings that have tenants in part of the space, so we leave that, convert the vacant space into what we call our flex product, and we've got a few offices and conference room up front and all warehouse in the back.
Yeah, but much more office than a traditional industrial building.
Yeah, where you have a few offices and like 100,000 square feet of giant warehouse space. All right, so that's the segment that we're looking at, and it's really like a needle in a haystack trying to find deals that fit into this segment. So from a market standpoint, we're looking at industrial and everything that applies to it as a whole. There's not a whole lot of information just on this individual kind of flex component that we look at, but right now we're seeing our market rents that are in the 14 plus square foot range, also with CAM reimbursements in there, whereas true industrial is
the $8 range.
Significantly less than that,
yeah,
but also on a much larger square footage.
Yeah, like the Prologis new big high ceiling industrial is going for $8-9 a square foot, when the older product, kind of like what we buy, call it 1980s to 2000 vintage, it's probably getting more like $6 to $7 a square foot.
Yeah, in that space.
Right.
Direct.
So flex is almost getting like a 100% premium to that. Where we're getting, for the same vintage, we're getting $14 compared to a warehouse that would be getting like $7.
Yeah. Yeah. So let's talk about what's going well in our space. The main thing that we are really focused on is leasing. Right. So we convert these spaces, and we are working on how do we lease this space up. Right now, the bulk of what we've been doing is taking converted office and leasing it. Our two most recent deals, the Hub that we recently closed and the Forum Flex deal, those are the two newest ones that we did. And those were both pure office conversions into flex use. And the Hub, working with the city of Milton, has been great. We've got a full building over there that we're under renovation work with. We already have tenants interested in leases that are signed up there, so that's exciting to see. The Forum, we just got fully occupied there. On the opposite side of the leasing front, when we look at like how do these deals perform, how are we, we're taking a product that has minimal revenue or has some problems and turning it around. That leasing front, leasing costs have definitely gone up over the past 2 to 3 years. We're now looking at around 6% leasing commission on the total rent, when it was maybe 2 or 3% a few years ago when we really got started. Also adding to that is there's the 1 month procurement fee for 1 month of rent, and more recently we've added in, not we, but the market has added in that commissions also include CAM. So if you have rent of 14 and you have CAM of $3 or $4, you're gonna pay commission on that CAM revenue as well, which is really just an expense reimbursement. And if you throw in, what we're seeing is if it's a longer term lease, you're going to get maybe a month of free rent per year that's added in there. That can take our leasing costs into the mid-teens on a deal, so it's definitely expensive to lease space, but that's really where the value is added as we get these things occupied and have renewals and can continue to keep the building occupied and going.
Right, and why this is so relevant and so sensitive to us right now is because we're buying a lot of vacant buildings. And so in order to go for vacant occupied, we hire brokers to fill them up. And yes, we have an internal leasing team that works with the brokers and really kind of helps smooth things and enables those tenants to get in there. But at the end of the day, the market is the market. The cost of leasing is still the cost of leasing. So number one, we need to take a vacant building to occupy. Number two, let's say we go from 0 to 100% occupancy and we bring in 15 new tenants. Not 100% of those tenants are going to work out. And so in the first and it takes some time for that to happen. We recently leased a space to a Formula One driving place. It's like simulators. And after 1 year, they blew up, and it just didn't work out. And we're working on releasing the space now. So we have, call it 6 to 9 months of downtime between tenants, and then we have additional leasing costs when we find that new tenant.
Yeah, and those, like, we're paying commissions for something that doesn't even fully pay now.
Right.
On that front. So, yeah, if we would have signed a 7-year lease, it would have been a whole different story in a much bigger kind of disaster.
And we would have paid 7 years worth of leasing commissions.
You got 1 year revenue.
Only 1 year revenue. We don't get reimbursed that.
Yeah, that's lost. If you sign a 7-year lease, pay the commissions for it, and they leave after 1 year, you're not getting any of that money back. So you're out of pocket all that. And we've been very careful with how we are doing our leases to make sure that we do not have those situations happening. It's something we're very conscious of as we go through this. But ultimately, like, when we look at the opportunities that are in this space, there are a significant number of deals that have really cheap rent. A lot of the deals we've bought, a tenant, sometimes they're occupied, but the rents are $4 a square foot, and there's like sort of CAM reimbursement. So you're buying that at an effective like 2% cap rate, right? It's like it just doesn't even really function as a deal. So it takes some time to get a lot of those tenants out and turned over. Some of the deals we've bought, like Top Notch out in Columbia, or we look at Pleasantdale, the Perch here, they had some really, really low rents. Davis Circle, where we had to spend almost 18 months, where if they have a lease, you can't just kick them out. They have a lease. We let that lease expire. We do work on the move out then. And then there's the cleaning up, white box process, the releasing process. So if you're at like 2 years of that segment, then you have a new tenant move in, like, it definitely takes a good amount of time, of which you have a lot of unknowns that are in there. So a lot of our deals, we've worked through that process, and now we've gotten to the point that we have really good walls, we have good tenants, and we have good rents. That process, if that's 3 to 4 years though, we're rapidly approaching kind of our horizon in the deal of 5 years.
Yep.
Right? And so now our most of our opportunities are taking deals that we've leased, we have high walls, and is it now time to exit them?
Yeah, I mean, the market is willing to pay for that higher wall. The WALT is weighted average lease time. And so a lease that has 1 year left on, a deal that has 1 year left on the WALT versus a deal that has 7 years left on the WALT, the 7 year is worth way more. It's way more bankable. It's way more reliable compared to the 1 year, which you can't really do anything with. You kind of have to wait that 1 year out. Similar to our retail strategy is that we buy these short-term leases at low rents, renew the lease at higher rents, and then look to sell it. Just the cycle sometimes takes longer with multi-tenants.
Right. Yeah. And what that does is, I mean, it definitely puts pressure on distributions, because it takes a while to get everything turned over. And then now what we're seeing is that cost when we are doing the turnover is definitely higher than expected, higher than was planned on, but reasonable in the sense that we're making them work. We're getting really good tenants out of this. We're able to get good leases. So it's been very positive, and there's a lot of demand right now for, we want to get in the space, we want to use the space, we want the space to look like something we can use.
Yep.
So leasing has been very positive. Lots of good momentum there. We're excited about that front. The component of it where we really have 3 deals right now. Where Davis Circle is a good example of this. We bought a 22,000 square foot building. Right? One of the tenants was paying $2, right? Like, yeah, almost nothing for 18 months, and they're now out. We fully lease this building, so we have a 7-year wall. It's an experienced tenant, so it wasn't a one of these 1 year short-term leases. And now it's really the highest value that we could be at, and that's the point in time we have to look at, do we have to recapitalize the deal, redo how we're going to think about reserves, or do we sell the deal? One of those things has to happen. We're going through that math right now on 3 different deals. So we have Dawson, Kennesaw, and Davis Circle. And Kennesaw, we saw great results when we took it to market, over $150 a square foot offer price, and we're working on a contract there or we're under contract there to sell it.
Yeah, our overall strategy here is to have a basis, give or take $100 a square foot, and sell for over 150 a square foot. And we're able to realize that on Kennesaw Flex, so we're pretty excited about it, and we'll see what we can realize on the rest of them. And if it doesn't, we still have a decent amount, like Dawson, for example, our loan is in the mid-4s for another 2 years. So not really the worst case to hold on to it, but we'll see what the market has to offer.
Yeah, that seems like the best way for us really to realize the value that's been created is once we have those long-term leases, is take it out to market and see what we can get.
Yep.
Right. On the opportunity front, we really kind of mentioned it's a little bit of a needle in a haystack. What can we convert to be this use, or is there something out there? We were able to find a few deals a year that really fit our criteria.
Yeah, I mean, a great example of this, convert story, right? It's like this Friars deal up in Chattanooga that we're working on. We've sent out a lot of communications on it about really the buying opportunity. Half the property is already a traditional flex deal, leased 100% to Volkswagen. The other half of the property is a flex deal being leased as retail. That we see the opportunity to basically fully occupy it and have kind of a hybrid flex retail deal, and then have the backstop that if any of the retail tenants don't work out, we have a great flex property, and it's newer built. And so, and the other property we're working on is an old film studio. We have not put this out to investors yet to show them, but like we've been working on doing our diligence. But it'll be called Atlanta Film Studios, but it's an old film studio that blew up, and it's a perfectly built warehouse and flex property built for filming, and we would go in and basically just put traditional flex tenants in there, mostly mechanical trades, etc. But the film industry just doesn't need the space anymore, so we have to do some kind of conversion to it.
Yeah, so that's 2 deals.
Yeah.
Right, that we found in the past, call it like 6-7 months.
Mm-hmm.
So our total really opportunity in this space, I mean, if we can find 3 or 4 good deals a year that fit exactly what we're looking for in the flex space, that's pretty good.
Yep.
We're excited about that. On a distribution front, all those go out on the 20th for the deals we have that are making distributions. Most of our stabilized deals are making distributions. Most of our deals where we're doing our lease ups and we're in the thick of all of this, and really that first 24 to 30 months, those are not making distributions as we get stabilized. But again, those will all go out on the 20th. You can check on your investor portals for all of the deal-by-deal specifics that are there, and our goal day is on the 24th. Love to see you join us if you can make it for that one. Okay. All right, thanks everyone. Appreciate it.